XJTLU Public Lecture Series. 欢迎各位莅临在西浦听讲座。I'm Professor Bei Tang from the School of Humanities and Social Sciences. It's my great pleasure to be the academic chair of this lecture series. Professors of XJTLU Public Lecture is our university's signature event for scholarly communication and knowledge dissemination. At XJTLU, now we have around nearly 50 professors through whom we would like to promote our university's unique research culture. This public lecture series will be delivered by XJTLU professors from different research fields, introducing their career-long research or a comprehensive review of selected research topics, as well as the cutting-edge developments in the field. The lecture series will be offered throughout the academic year to both XJTLU staff and students, as well as the public audience. Through stimulating presentations using plain language, the professors of XJTLU Public Lecture Series will explain complex research topics and bring showcase of our university's research impact and its contribution to our community and society. Today's speaker is Professor Xuezhong from the International Business School Suzhou at XJTLU. Professor He joined our Department of Finance in 2022. Before joining XJTLU, Professor He was a professor of finance at the University of Technology, Sydney from 2010 to 2021. Professor He has 2 PhDs. He did his first PhD in applied mathematics in 1995 from the Flinders University in Australia. And then in 2001, he received his second PhD in finance from University of Technology in Sydney. Between 2013 and 2022, Professor He had been a co-editor of the Journal of Economic Dynamics and Control, an A-star journal in the field for 10 years, in addition to his editorial services for several other journals. Professor He is an internationally recognized expert in asset pricing, financial market modeling, market microstructure, financial economics, and nonlinear dynamics in finance and economics. He has published 1 book, 15 chapters, and more than 60 journal articles. His publication has been highly cited more than 3,000 times in Scopus and 5,000 in Google Scholar. He also received multiple competitively Australian and Chinese research grants. Professor He today will share with us his insights on the topic of high-frequency trading and market liquidity. Professor He will speak for about 15 minutes or to 1 hour, and then we will open the floor for questions and discussions. To the audience online, today we will live stream both Professor He's lecture as well as the questions and the discussions. Please stay with us. So without further ado, I give you Professor He.
Thank you, Professor Tang, for a very nice introduction, and also I'm glad to see Professor Rai is here, and also I would like to thank my colleagues and students, and to have this open discussion on this particular topic. I guess investment is one of the most important part of life, right? And if we look at behind the investment, and how stocks are traded in the market, probably is most important fundamental questions. So I guess we need to understand how stocks are traded in the market, right? Before let's say put into this into a big picture of investment. So today's lecture is trying to have some discussion about to understand that how the stocks are traded in the market, and in particular I would like to focus on 2 related concept. One is what we call market liquidity. Other one is related to the high frequency trading. So basically, we'll have some take today's opportunity to have some kind of open discussion about how to understand trading mechanism in the market better, right? So this is my hope. So I wish by the night of today's lecture we have some for those people who have who are not expertise like my colleagues here, right? And have some ideas about how the financial market functions. Okay, so okay, so without further ado, let me just start with this news video click about the flash crash.
Fear came back into the market in a very big way. What began as a national problem in Greece has quickly metastasized. 400 very quickly and then down 880,000 in a heartbeat. I mean, it is classic capitulation. There are some people who are proposing there was some kind of fat finger error. We have commodities that are being pressed. There may have been a bad trend in Procter and Gamble. This is very much 1987. Since panic selling on the way down, and all of a sudden it stopped on down and back by 700. It's all happening in real time, folks.
So this was the first time flash crash, was named, right? And back today, it was like the biggest market price change during the intraday trading. So if we look at closing day price, probably we don't realize there's a larger price fluctuation in the intraday data. But if you look at what happened with so this is back to the May 6, 2020, happening in the afternoon around 2:30. So whole process actually only lasts for something like a half hour. So the initially was Dow Jones dropped by 1,000 points, which was like 9%, and they within that is spread to the other index as well, like SP. SP 500 and Nasdaq, and they recovered, bounced back within something like half hour, right? So, but at the end of the day, we don't see that dramatic change, right? So that was the first time we had this concept with what we call the flash crash, which reflect this sudden price change in the market over a very short time window. That by that time, that was the largest daily drop, intraday drop, but later, actually, there's even one big one later. I will show you shortly, right? So, so this is basically this plot just indicated what happened in terms of price change, and you can see that around 2:30, and the price actually plunged dramatically, and they rebounded back within about like half hour, right? And so this blue line indicates what happened in the stock price change, while this red line indicates the trading volume. So what we see here is the volume was high and unbalanced. That means there's a lot of sales, but not enough buyers, right, in the market, and the liquidity was low, right? So we'll come back to this liquidity. What do we mean the liquidity is low later, right? So this was the first flash crash we had experienced. And later, we see similar thing happening in bond market in October 15, 2014. And on this day, the US 10-year note for the 34 basis point within just minutes, right? And this for the interest rate yield and pushing the price, bond price, increased dramatically, right? And this also happened within minutes. And we also see this kind of a crash in the ETF market. So this happened in August 2015. So what happened was, look at Dow Jones and within 6 minutes it's dropped like by 1,100. So this is largest intraday drop in terms of points in the history. So we go back to the flash crash. That was the second largest one. So this is the largest one, and in first 6 minutes that's what happened, and they followed it in the following 8 minutes and recovered 600 points. So by the end of the day, it's only closed down by something like 3.5%, right? And they this particular fund, which was based on the SP 500 equal weighted ETF, and at some point lost almost like 43%, right? So this is what we call the flash crash on ETF market, and they seem to happen in the exchange rate market in 2019 and the January 2019. What happened was initially we see the Aussie dollar exchange rate between Aussie dollar and Japanese yen fall sharply by 7%, and we also in the middle of the month we see the Swiss francs skyrocket by almost 20%, right? And we also see this kind of event also in other market like futures market. So we have this commodity futures flash crash in 2011 happened for those futures contract for the crude oil and gold futures, and also at the beginning of the COVID we also see the trigger of the option market flash crash event, right? And of course, we still remember this fat finger event in China, and that was caused by this incorrect mistake, right? A purchasing order of the billions of incorrect purchasing order, which actually pushed the Everbright stock price, pushed to the roof, right? So this is also like what we see in the Chinese market. So as we see that, over the time, we see this kind of crash among different market. Market-wise, we also see in different market, equity market, commodity market, and option market, and so on and so forth, right? So it seems like this kind of a crash continues, trigger what we call heated debate about relation between market crash and high-frequency trading. So many people believe that high-frequency traders should be blamed for those kind of events, right? So that was accepted, although maybe it's very hard to find evidence to see that, but that's what the people believe, right? Particularly seeing that this could trigger by some kind of shortage of liquidity provision, right? So there are some concerns or factors actually associated with all those events, and say for example, as I mentioned, like high-frequency trading, right, and liquidity imbalance or shortage in the market over the very short time period, and maybe we have a very weak market structure, right, and also maybe this due to the popularity of the algorithmic trading, right? And also maybe due to some mini crash in individual stock. So if we look at data in those individual stocks, and we can see those kind of a mini crash, what kind of mini crash in individual stocks. So what happened in this, if you collectively you have those mini crash in the individual stocks, that will actually increase the uncertainty of the market and may push the market-wide flash crash. So there's various reasons, like suspicious about what was a driving force behind flash crash, right? So this is also concerned by regulations, right? As called here by SEC Chair Mary Sharpe in her comments in the Economic Club of New York on September 7th, 2010, right? So she said that the issue is whether the firms that effectively act as market maker during the normal time should have obligation to support the market in a reasonable way in tough times. Okay, so you can see that, so here, there's one important participant, which is what we call the market maker, is singled out. It says, well, market maker, in general, by, if particularly for designated market maker, they are responsible to provide liquidity. The question is, what happened to those market makers during this flash crash, right? And so that was also probably one of the main issues or concerns about, whether those market makers should provide liquidity in tough time. And later on, we will see that, there are many market makers, particular HFT can act as market maker, but they may not have obligation to do so in the tough time, right? So that could be the reason why we have this kind of liquidity shortage. I'll come back to this point later on. So this actually calls for need to enhance market surveillance, improve risk management practice, and also transparency for high-risk trading, right? So the question is, what are the behind it? Like, what are the basic things behind those events, right? So this is basically I would like to discuss with you in this talk, and we'll see if we go back to very basic things. We want to see that we try to understand what is liquidity, how to measure the market liquidity, and how stocks are traded in the market, and how the high-frequency trader is different from the low-frequency trader or retail traders, right? And what is the impact of HFT on the liquidity, and what are the policy implications, and what we can as investors, right, from this this whole process, right? Okay, so let me start with just liquidity, right? Liquidity and trading, right? Go back to very basic sense to try to understand, the root of the market liquidity. So liquidity, by definition, so here's a academic definition, is that liquidity refers to how easily an asset can be bought or sold without significantly affecting its price. So this is an academic definition, right? So what does that mean? Well, basically that means, if you go to the, a grocery store, right, in the supermarket, right, and most likely, we will see this is normal, right, normal case, right? So we have, enough supply to already available on the shelf and easy to purchase, right? So whether if there's not enough supply, right, and we will see price will increase, right, and vice versa, right? If it's oversupplied, right, and the price will be dropped, right? So this is basically talking about liquidity. The question is, if we look at those financial assets, so what are the liquid assets and what are the illiquid assets, right? So we can think about liquid assets such as cash, government bond, and all those big stocks, right? So those are the most liquid assets, which means those are the assets highly liquid because they are actively traded in deep market. So I'll come back to this point, what we mean the deep market. So basically, you'll see that in this case, there are many buys and sales, right? So wherever someone wants to buy, and there's always someone willing to sell to you, and vice versa. And also can accommodate whether it's a small amount or big amount. So this is what we call deep market, and also in terms of price, and it's a minimum impact on the price change, right? So this buy and sell does not change price dramatically, right? So this is what we call a liquid asset. The illiquid asset would be something like in real estate, right? And your motor vehicle and antiques, right? Those are private equity, those kind of things, right? And so those assets would take much longer to trade, right? To buy or sell, particularly to sell, right? So very often it's associated with a bigger price discount, right? So those are some examples about liquid asset and illiquid asset. So in general, and liquidity in financial market is like a water flow through the pipes for our daily life. That's what we need, right? Well, the flash crash would be like thunderstorms that disrupt normal market function, right? So the question is, how do we measure the liquidity, right? So this is let's say before we talk about how to measure liquidity, let's see what kind of order trading orders we have in the market, right? So if you look at on the left, right? So we always want to buy low and sell high, right? So if you want to buy a stock, you pay low price, you will willing to pay as low as possible. And if you want to sell the asset, you want to sell as high as possible, right? So basically, let's say we have someone wants willing to pay like $20 here to buy asset, and someone is only willing to pay $21, 24, right? On the other hand, his 20, let's say this is sorry, should go down, right? 20, 18, 19, right? And on this side is 21, 22. So someone is willing to sell, right? So we have those orders are what we call the limit order, right? So limit orders are the orders people willing to the price with people willing to pay to buy or sell, right? So say for example, in this case, if this is $20, this is 21. So if someone willing to pay $21 to buy stock, and that order is effectively become market order, which means that order will be executed immediately, right? You don't have to wait. But otherwise, for those limit orders, you may have to wait. You may have the chance of the order not to be executed, right? So of course, in this case, the higher the price you paid, the less chance, the higher the probability of the order will be executed, right? So that's why we have this, the queue of the order, right? And so we have, this is what we call the limit order book, right? So in general, so those limit orders are what we call provide liquidity, right? That means, those investors, those orders are there for people to trade, right? So if someone wants to use market order, so they can cross the market and trade straight away, right? So the difference between those two is, of course, if it's market order, it's costly more, right? You have to pay much high price compared to limit order. But the advantage is market order will be executed straight away, right? So if you do believe that this is a good opportunity, you would take it, right? Rather than wait for, right? You may lose it, right? Use limit order. So those are the two very typical types of order, right? Market order and limit order. So when we talk about liquidity provision, we in general talk about limit orders, right? And liquidity consumption means we have market orders to consume the liquid orders, right? But there's also some other buy stop or loss, sell stop orders and so on and so on. So this is basically how stocks are trading, right? So those apart from different price level, we also have the quantity, right? So this indicates what is how deep the market in particular price level, right? So with those feature of the limit order, let's now look at the first measure. So first measure is what we call the market depth, right? So market depth basically refer to the volume of buy and sell orders at different price level. So if we go back to this, here's an example. So if you look at, so this is buy orders, those are sell orders, right? And remember that this order book changes over the time due to the trading, right? So this market depth refer to the volume, right? So high volume means market is deep, right? So that means even some market orders are executed in the market, and that does not change the price dramatically, right? So basically, deep market and make it easy to execute traders without cause significant price movement. So this is one measure to measure the market liquidity. Another measure is what we call the bid-ask spread, right? So here we have the highest buy price. So basically here, right? Highest buy price, let's say if it's $19, right? And this is $18 or something like that, right? So highest buy price, and this is what we call the best bid, right? And the similar story, the lowest sale price is called the best ask, right? So let's say, if best bid is $19 and the best ask is $19.10, right? And there's a difference between best bid and best ask, which is 10 cents, right? Which is what we call spread, right? So spread, I basically measure that if you trade around, what is the price change? Clearly, if we aim to have a minimum price impact, we would like to have the smaller spread, right? So the narrow spread indicates you have high liquidity, right? Because the cost is low, right? So this is another way to measure the liquidity, right? Okay, right. So now come to the next question is who actually provides liquidity, right? Well, this goes back to what information do we have, right? So this information is not like not only traditional information about what is the fundamental value of the stock. It could also include the information about trading history, price trend, order flows, right, and order book information, right? So those other informations, if you have some information about, like order flow, fundamental values, and you could be called as informed traders, right? Like very often we call those institutional traders or sophisticated traders. They are informed in the sense that they have much more information. They also have a bigger capacity to process this kind of information, right? And like for retail traders, even we have information, we do not have capacity. We don't have capacity to process information. That information becomes less useful, right? So in general, we would say like, if we have those informed traders, those informed traders will intuitively provide liquidity if the mispricing, which means the value and the pricing is the difference is small, right? And in that case, they're willing to submit a limit order to wait for the opportunity, right? Because the mispricing is small. But if the mispricing is large, they'll probably more likely to use market order, right? They don't want to lose the chance, right? Because by putting limit order, you may have the chance lose the trade, right? Because order may not be executed, right? So informed trader can either provide liquidity or supply liquidity. And we also have what we call uninformed traders, right? Uninformed traders are those traders who have no information, right? So what they trade, well, they can only trade based on those market information. One example is, if I'm uninformed traders and also there's a big market buy orders in the market, so I can learn from these buy orders, which may imply that price may go up. So I may follow those market buy orders to get into the market to buy the stock, right? So this is kind of the trade chasing strategies popular among the retail traders, right? And there's some third category is what we call liquidity or noise traders, right? And those traders in academic literature, they are just traded randomly. So they trade for maybe for liquidity purpose or maybe for some other purpose, right? Or maybe based on the gossip, right? So in general, we assume that in this case, like those uninformed or liquidity noise traders are what we call the 韭菜, right? Where informed traders are called like sophisticated, right? So as we know that, well, at least empirically, we know that informed traders make money from those uninformed and liquid traders, and the uninformed traders maybe make money from those noise trader or liquid trader, right? So that's in normal situation, but this is not always the case, right? So probably we all remember this event of GameStop short screening, right? In January 2021. So what happened is GameStop was overshorted by 140% by those institutional traders. Right? And then what happened is, those retail traders, through this social media platform, they keep buying the stock and push the price from $70 to over $500. So that is that gives a big loss for those institutional traders, right? So this is so which means if those novice traders or uninformed traders, if they coordinate, and they could make huge impact on the market, but like in our economic model, rational models, we don't see these kind of things, right? We are normally assume that they are just 韭菜, right? So this is basically how those different traders trade in the market, particularly in terms of whether they provide liquidity or consume liquidity. And in particular, there's one type of trader is called market maker. Market maker. So there, particularly we have what we call designated market maker. So those are the traders who have obligation to provide liquidity. In return, they will be paid by the exchange for providing liquidity, right? So this is what we call the liquidity rebate, right? So the reason is exchange will charge, make money from all the traders, right? But doesn't matter, you buy or sales, and exchange will charge your fees, right? So to make this market to be to collect more fees, they need to have this market to be very active, right? So that means they need someone to maintain the very active market. So they are asked market maker to provide liquidity to facilitate all the tradings in the market, right? And so that they can make profit from this high trading volume in the market, right? So those are the traders in general. They provide a service. They provide a service. In return, they get fees from the exchange. But there are certain later on, for those HFTs, right? They are not designated market maker. So which means that they have no obligation to provide liquidity all the time, right? So I'll come back to this point later on to say, for those market maker, right? And they may change their positions in certain time, and that may cause some problem for the market, right? Okay, so basically, in sum up, liquidity provides flexibility and allows investors to quickly adjust their portfolios in response to changing market conditions, right? And particularly, this is what I just mentioned, liquidity rebate offered by the exchange incentivize market maker or traders to provide liquidity, maintain market stability, and facilitate economic activities, right? And of course, the lack of liquidity can, push the market down and maybe makes the financial market unstable, right? May cause, in worst case, may cause market crash, right? So, as an example, you see that stop loss is a common strategy for investors, and very often it's implemented by algorithm trading, right? So that means you have to cut off your loss with a price drop beyond a certain level. But if this stop loss strategy is implemented by algorithm trading across different forms, and that could cause a fire sale, right? And this kind of a fire sale could have a very significant impact in short run, but it could also have an impact on the long run, right? Okay, so this is one example. Another example is this financial crisis, right, back to 2008, and this is what we call the liquidity squeezing during this financial crisis. So what happened was we have those predatory lending in subprime mortgage, targeting on those low-income home buyers, and also we have this excessive risk-taking by those financial institutions, and also continuous build up of those toxic assets That means those assets which are actually not has much less value than what they claim, right? And from bank, and all those build up these bubbles, right? Bubbles, and that eventually, with bubble burst, we have this great recession, right? And so this is the extreme situation. We see the like market goes one way, right, and that could push price, make the market crash, right? So that was about liquidity, right? Now let's look at how the trading actually happened in the market, right? Look at the evolution of the stock market and trading, right? So I guess probably you are all familiar with this scenario, right? From Bar, right? And so this is probably Chinese story about the early stage of the share market. So by back to 1920s, you may have to go through to trade the stock. You have to get this 股票认购证, right, to be able to buy the stock, right? And people can speculate on that. So this happened between 1990 and 1992. But if we look at the history of the global market, right? So exchange was set up back to early 17th century, right? And they, roughly you could claim that the beginning of the hyper trader started with late 17th or 18th century, right? Which means people trade more frequently, right? And around between 1900 and 1970s, we see considerable change in financial market, right? And in the following 20 years, we actually see the growth of stock market, and we start to see the option tradings, right? And by 2000, 2010, and see the boom, right? Boom of high frequency trading, right? That's most active trading in the market. And in the past 10 years, we see even emerge of the new space trading of the high frequency trade, right? So this is basically what happened in terms of history of the option trading, HFT and HFT based on the news trade, right? So in general, so this is how the stocks actually trade, right? Broadly speaking, so we have the investors, right, and they can make orders, they can decide to buy or sell, and they can choose either use market order, limit order, right? So they come to the terminal, personal laptop, and send orders to the broker, right? Well, broker will have certain algorithm to decide how to send the orders through different routes, right, to the exchange. So those execution auction could be in the order of what called a pin sweep exchange post or dark post. So I won't touch up the details about this, but basically, so there's some certain algorithm help traders decide to send the order through which routers to which market, which exchange. So this is something we decide to buy a pizza, right? You need to decide whether you want to dine in the pizza restaurant, or you want to pick up, or you want to be delivered, right? You make these decisions, and they somehow you need information to figure out which store would be the which store you should go to get. Of course, if you want to pick up, right, it delivered, still have hot pizza, right? You want to have short the distance, right? So that will relate to similar to which routers you want to use it, right, to for your order to be executed. And there are certain ways regulations in market actually regulate how the trade should happen, right? There are many rules, and here, so I'll just highlight this first one. It says order production rule, and I'll give you an example in the next slides. So basically, it's saying that if traders send orders to different exchanges, different exchange, you can send orders to the New York Stock Exchange or NASDAQ or SP, some other platform, right? And this will guarantee that you will get your best price, right? And so this is a rule. Another second followed by this, what is if you if you trade, what is maximum cost of fees, right? And then what is the minimum tick size, right? So if you put orders, you cannot say 0.5 cent, right? So minimum would be 0.1 cent, right? And they which market can actually do the trading, right? It's not any value can actually trade the stock, right? So here's one simple example is what we call smart order routine, right? So let's say we have a buy market order of 1,000 shares, right? So then you look at those are three different exchange, right? And they have those are the bid ask information, right? So if you have buy orders, you want buy market order, you look at ask side, right? Of course, you want to buy at low price as low as price as possible, right? So if you look at here, right? So first one offer the $100, 100 euros, right? Next one is 98 and 99, right? So intuitively, you can see that this order should be executed into at 98 for 600 shares, right? And the rest should go to the next best price, which is 99 euros at 400. And there should be no orders, goes to trader at 100 euros, right? So this is what we call the smart order order routine, right? So this is part of the regulations, market regulations, to ensure that you have this best price for investors to trade, right? Another thing is if you have a selling market order, right? So you can approach to different values, right? Value 1, value 2, right? So you could if you go to in this way, so this is price, right? If you want like a sale, you want to sell as high price as possible, right? So if you have this, right, you have high price sale in this value 2, but you also sell at value 1 at low price, right? So this is not it is not in the best interest of investor. So what happened is in this case, an order should be split in this way, right? Fulfill the all the orders at price level in value 2, and also in uniformly distribute those 2. Similar story happened here, right? So this is just make sure that the orders are traded at the best prices, right? So this is what we call a no trade through. So there are many those kind of rules to make sure that we have a fair market for investors, and of course very often it's very hard to detect what we call a market manipulation, right? Even with those rules, right? Now let's move on to what we call the high frequency traders, right? HFT, right? So basically, this is instead of people trade on the trading floors, now people trade based on the computers, right? Based on the computing power, right? So this is very typical examples about HFT, right? And so what happened here is so in 2009, this company, Spread Networks, spent $300 million to have this fiber optic cable, which stretched 1,300 kilometers, that cut straight through the mountains and rivers from Chicago to New Jersey. For doing what? To reduce the transmission time of the data from 8.0 millisecond to 6.5 millisecond. So that is the reduction of 1.5 millisecond. 1 millisecond is 1,000 second, right? So this is very, in terms of time, right? So it's very small amount of time reduction. Well, you may think about it, well, if the company is willing to spend $300 million to do this, of course they would expect to make more than $300 million from this providing service, right? Otherwise, there's no point to do so, right? So this is typically, this all those clouded means, there are the weather stations along the way, and those radar symbol indicate all those microwave connection. So as this paper got some award as they claim that every cloud has a silver lining, fast trading, microwave connections, and trading cost. So this is an example illustrating what we mean the fast trading, right? By doing this, you can reduce the transmission time by 1.5 milliseconds, right? That can actually make a huge difference, right? So basically, what we see a typical feature is in terms of high frequency trading, and we have the speed competition among different providers, right? Like different routers and brokers and exchange, right? So this speed competition, can go from milli, micro, and nanosecond, and auction very often is implemented by auction trading, which involve high speed, large in size and scope, and quick reaction to the market information, and high turnover, and cancellations, right? So that's actually that many orders be cancelled due to the high speed. That means HFT can send orders to different platforms and to see, if they really want to trade the orders, they will see that once order traded in one market, they will cancel all the orders in the other market. But sometimes they also can send fake orders, right? Try to detect, like a market liquidity in particular value, right? And and also it reduces exposure to adverse selections. That means, if you put limit orders so fast trading can reduce your risk in terms of trade at worst price, and also effectively manage the inventory, and also trade before the liquidity provider just new information can get a better price, right? Instead of, let's say, if you want to buy, you can put a limit order to buy, and with fast speed, you could buy at a limited, like low price for the people who follow you, and they have to pay high price, right? So this is those are the typical features of the HFT, right? Okay, so this slide just illustrating like what we mean the speed, right? So speed is trading speed here is broadly speaking is can be divided into what we call the speed, a network to gateway latency, right? And another one is exchange latency, right? So here it basically says, well, we have different traders, right? Different traders trade through different brokers and different routers, right? So depending on their speed, right? So their order could be, in different queue, right? Like in this example, right? Like the trader B order will go first in the front and followed by those order from A, right? And this is the other way around. So depending on the your transmission time, right? Your order could be, even you have the same order, and your order could be either in the front or in the back, right? So because if you come first, you're ranked on the top, even at the same price level, right? So this so one speed is reflected by this what we call the network to gateway, right? This is what gateway. And then in the exchange latency, there's actually two parts. One is gateway process latency. That means we order actually come to the gateway. Gateway need time to validation, right? Validation time, right? So process those data, right? Those data to verify, those orders, right? So those this different speed can put those orders in different way, right? And they are once they validated the orders, they are send this order to the exchange, to this what we call to this matching agent, right? To match the price, like say to match the buy and the sales and so on and so forth, right? This also the speed will matters depending which one is fast, right? Your order will be in the different queues, different position to be executed, right? So this is this is the trading speed we talk about. So basically, you can see that the speed depends on the how fast your order gets into the gateway and how fast your order is processed and executed by this machine. So I'll skip this. I mentioned that before. So basically, the issue is here is HFT can be what we call the front running, right? So this is basically the highlight of this book, Flash Boys, right? And so which means the traders can buy before filling retail. So you have brokers, right? Brokers or dealers, they can buy before the retail order, buy orders be filled. So that means retail has to pay high price. So this is what we call the front running. But there's also another thing we call the back running. That means you can back running from fast market and front running in slow market. So this is possible, if you have multiple trading venues, right? And then you have fast speed, right? So you can take this speed difference and you can collect all the information from fast market, and this is what we call background, and then you can use the information to trade in the stock market in the front of the retail market, right? And of course, HFT often relates to rapid order cancellation and the sudden shift of the trading strategies. So you will see the huge order book on the best bid, and in very short time window, and it just simply disappeared, right? And simply because those limit orders be cancelled by those traders, right? For some other purpose, right? So because trader firms can send orders to trade in different venues, so you have this. So basically, liquidity is fragmented across different venues, right? And so you have a less liquid market in different venues that can cause like a dramatic price change, right? So those are the common issues for HFT, right? So this slide just illustrates like how fast the trade, right? So this is just saying that within 0.01 second, there's 77 quotes within this time window, right? You can see that. So those are the orders within 0.01 second, right? You can see how active of those trades, right? And also this is trading volume, right? So this is 1 day in the life of the HFT, high frequency trader. So basically, this is a trader for the stock of ING, right? So you can see this is a buy sell orders, and so this is within 1 second. You can see that very often you could have like between buy sell between 200,000, or in the extreme case you could have something like 250,000 shares, right? So there's huge trading volume in this process, and let's take this example to see how profitable HFT, right, in this business. And so this is Venture Financial, and it's market maker. So we provide those trading platform, right? This is what they claim, right? Leading global market maker, combine market structure, expertise, and execution technology in order to provide competitive bid and ask offers in over 25,000 securities at over 235 venues in 37 countries. Right? So this is this is not very clear. So what we see here is this is just seeing that the daily trading, so in the horizontal axis is a profit in terms of let's say we take the highest one is the daily profit is between 1.3 to 1.5 million dollars. So if you look at from I think 4 years time and how many days they actually make profit between 1.3 and 1.5, right? You can see that if you put all together something like 371 days, they actually make profit between 1.3 to 1.5, followed by 1.5, 1.8, so on and so forth, right? Okay, so you can see that they actually the interesting is if you look at the order, the trade, each one, whether they make profit or loss, right? Actually, they're equal. So half the order they actually make profit, half the order they actually lose money. But the point is, when they make money, they make a lot of money. So if you look at history, they claim that over the 4 years' time, they only have 1 day lose money, all the rest they make money. So that's why they claim that in 2014 they made $190 million, right? Okay, and in terms of transaction, the daily transaction level would be something like 5.3 million in terms of volume. Right? Okay, so let's now see the effect of HFT on market liquidity and stability, right? And so I guess what we produce understanding of the market liquidity and how the HFT traded, and you can see that there's some positive effect, right? Positive impact on the market, including HFT firms can monitor market conditions in real time. And just quote accordingly and continues quoting bid-ask price, narrow spread, and also absorb income, buy, sales, and facilitate trading in the market, right? So that's a contribution, positive contribution to the market, and also HF can maintain the tight bid-ask spread, and to make the market be liquid and tradable, right? And also improve market efficiency. Right? So this is all the positive side, and some academic research provide evidence on this positive side, but also clearly there's some negative side on the HFT, and partially due to this market fragmentation, and also because maybe this rebate scheme also trigger, encourage the access trade other activities. So this leading concerns about market stability and resilience. There's also some empirical evidence to support this negative aspect, right? So in terms of mechanism, right? So this I want to use this plot just to illustrate what is intuition behind this liquidity evaporation or dispatch, right? So basically what we see here, so in general, you have a liquidity demand from informed traders and you have a supply from HFTs and those traders, right? So in normal market, you can see that your demand and supply of the liquidity are pretty much balanced, right? So if the information you receive by HFT is not extreme, right? And this is balanced market, and they will actually help facilitate market liquidity. But then what happens is, if they receive the signal which is indicate that mispricing is large, let's go beyond this, either here or here. Suddenly, those HFT will jump to the other side. Instead of providing liquidity, they will consume liquidity. And suddenly you have this mismatch. It has a gap, right? There's a gap in terms of liquidity. And this gap, this mismatch will cause price change dramatically, right? And there's empirical evidence seeing that, right? So like if you look at large buy orders from institutions, right? And initially, HFT will sell, go outside of those large buy orders, but later on, they go in the same direction. Same story for the selling order, right? So this indicates that those other traders, they have no obligation to provide liquidity. They can change the strategies depending on the market condition quickly, right? And so as a result, you will see that a big price impact, and which can trigger what we call a flash crash, right? So there's clearly there's some policy implications, and let me briefly go straight and time constraint. So basically, you can see that those are the SEC, like exchange, Security Exchange Commission, and Commodity Future Trading Commission. Those are the market regulators, and they actually, try to ensure that we have fair and orderly function financial market, try to protect investors, right? And so there are some kind of reforms from those market regulators to change the market structures, risk management, and surveillance capability. And policymakers, of course, also try to regulate this market and try to stop this potential cascade disruption of financial market and develop some kind of coordinated response to mitigate those kind of risks. And this is probably one of the recent examples from Chinese market just past few days, right, to stop those fake orders, cancellation orders, right, and to make the market more fair to investors. So there are many implications in terms of like liquidity management and also how to respond to those kind of events, right, including market surveillance and cycle breaks, and this is this was implemented a few times at the beginning of the COVID, right, and also try to control the HFT activity. And some scholars even propose to have instead of have continuous trading mechanism, you have this what we call the batch auction, which means instead you trade every millisecond, let's say you can only trade every second, right? So within each second, all the orders collected together and they trade second by second, right? That actually reduce the frequency of trading, right? And recently there's some decentralized finance automatic market maker mechanism has been developed, particularly in the digital asset market, use blockchain and technology. So this is something like we may see some new trading strategies, trading platforms in market in the future. So here I just want to mention what do we mean the market participator, which include all those hedge fund, institution traders, and also include HFT firms, right? And they actually face this reputation risk, right, due to this all those features we talked about before. And as for the ordinary investor, of course, this to understand how stocks trade in the market, particularly those less liquid market, less liquid asset, and that could potentially more affected by this kind of flash crash, and this may affect our portfolio value, our portfolio, and also to increase market volatility and risk. And another thing is this may reduce our confidence on the market, right? If we don't know what really happened, and this may have a negative impact on the market, confidence in the market, and that may spill over to our daily life and even our long-term investment and consumption and so on. Right? So I guess for other investors, I think one thing we can say is we need to understand how this market actually functions and to be informed about what happened, and so we should encourage all those market regulations to improve the market conditions and eventually they'll benefit investors, right, in the long run, right? So I think staying informed is a very good way to know what we are, particularly if you trade in the market, whether you want to trade more frequently, and this is most relevant, or you want to trade for long term, right? You buy and hold, right? So this could have different implications for your trading strategies. So let me stop here. I'm sorry to be over time by 5 minutes.
Thank you very much, Professor He, for such an interesting talk. I hope we all get some useful tips of not being a 韭菜. So we now open the floor for questions and discussions. And I'm pleased to say that we already received one question from our audience online. So Professor He, I will raise this question on behalf of the audience online. The question is, how is the Chinese domestic HTFs different or similar compared to those in the United States?
Good question. To be honest, I don't know. I don't know whether HFTs are allowed in China. It is.
For only certain markets.
Yeah, it's very limited. I think in China we try to reduce the negative impact on HFT, and I think in futures market, right?
Only index futures.
Index futures. So it's not in stock market yet.
Thank you. Now I have another question from a student. Is asking what courses would help graduates to get into the jobs at HETF? Thank you.
Come to our class, right? And yeah, well, if there's something we don't know, just learn it, right? But learn it and you know how to deal with those kind of things instead of know nothing, right? So come to the class, right?
Yeah, to put it in a simple words, what Professor He is trying to say is just join the business school at HTLU.
Well, you could join some other faculties, right? The schools in Taicang, let's say, for example. We develop some fintech and AI program, yeah.
Okay, do we have any questions from the onsite audience? Yes, please. Take this one.
Professor He, you mentioned that the flash crash may be due to the regime change or the algorithm changes to the high frequency tradings. From they are shifting from liquidity providers to the liquidity demanders. So what if we propose a regulation of dynamic liquidity provision or transaction fees? So in these rare cases, we can provide much more rebate than usual to attract more liquidity. And we charge normal transaction fee during normal times to fund this additional rebate. Would this dynamic transaction fee improve the way that we transact and to reduce the flash crash risk?
Yeah, that's what they're doing. They actually, I think this rebate, like a rebate program initiated by exchange, was very popular at some time, and which means, you know, if you are a market maker and you know, if you provide liquidity, let's say there's only one tick, the spread is one tick, right? So by offer half tick rebate to you, and you can make half tick profit. So this is one typical example. Exchange actually, you know, provide this rebate to HFT to trade more. And later they actually, you know, they realize there's some problems with this scale. They actually step backwards and try to, well, not disencourage, just try to have a balance between provide liquidity and over trading, excess trading. Right. So this is related to the, you know, market design issues, right? It depends on which market, depending on which stock, and maybe there's different strategies or rebate scheme to be designed. So this is why we need to understand those what we call the market map structure to be able to design the market better to see. Well, maybe like this rebate scheme is it's a good thing for certain stocks, or maybe not for others. Right. Thank you.
Thank you.
Thank you. I got another question from the online audience. Is CQF helpful to job seeking?
What is that? CQF. What is CQF? Sorry.
Certificate of Quantity Finance, maybe.
Definitely, why not?
Okay.
If that is the case, certificate of quantum finance, huh? Well, quantum finance is like early stage of algorithms trading, much more driven by quantum finance, like people who work in the quantum finance industry, right? So to have knowledge about, you know, what are the algorithms behind those things definitely helps, right? Whether that helps you to make money, that's a different issue, but help you understand better, right? And how it works. Yeah.
Thank you. Any other questions from the audience?
Maybe I
Yes,
ask one
please.
question. Yes. Maybe I ask. Thank you, Tony, for a nice presentation. So my question actually, I tried to resume a question raised from the student online. Say he or she is coming to a class, and today we are asked to provide the so-called innovative teaching. And the students actually looking forward to the teaching, say, at least I think smart sufficiently. So what's your opinion for a student to, when they come to your class, and what's a way, or in what way do you think they should, get engaged, study efficiently? I don't know how to say, maybe just say outperform in class, and eventually one day leading to the competitive margin in job market. For example, I think a lot of we have good audience, but people don't ask questions on the slides. The reason is it's too hard. Maybe it's time to teach us how to learn your class.
Okay, that's very good point. Good questions. And short answer is, we have a trading flow to be used for teaching purpose, right? So that means we can have those very basic understanding about how stocks traded in the market, and then we can actually implement this in the lab. Let's say, for example, like trading flow, right? And we can there's some countries that some develop in terms of some university, I think Tianjin University, tried to develop a program which is put the student into the lab, compete with a robot, right? To see whether robot has a chance, right? And with all those learning mechanisms behind that, and I think that's probably for the step to try to understand, what's going on, right? But before you jump to the trading flow, we have to know, those basic knowledge about the trading and all the books and how market functions before we talk about whether I should trade fast or slow and what is trade-off and all those kind of things. Yeah. So I think our university provide a lot of opportunities to be to learn better along this way, right? Like all those AI components in the modules we have, the university trying to push would be part of this exercise. Thank you.
Thank you. Any other further questions?
I actually got a question online from my friend.
Oh yes, please ask from behalf of
Maybe I
your
can ask on behalf of her. Thanks. There's a question about how to utilize technology to enhance liquidity management overall, maybe more precisely in high-frequency trading.
I'll just give you an example. It's a big question, but very challenging question. And this is the new trading mechanism, which called decentralized finance. Currently, we trade through the exchange, right? So this is a centralization process, right? And although we have different values, right, and people still trading the central platform, and then you have this, you may have people may send the fake orders and cancel later and so on to disturb the market functions, and this is coming to the stage where people trade cryptocurrency, digital currency, and so to for regulations, it's very challenging to see that whether particular HFT firm manipulate market, because you probably cannot trace what happened for this particular firm, right? And even you can trace, you may need a big effort to do so, right? Well, if like if you have this decentralized trading, automatic market maker mechanism, trade through the blockchains, and that could potentially solve this issue, right? And so what happened there is this is something I'm still learning, right? Just based on my limited knowledge, there's no limit order and market order at all in this market. So basically, you can change among different currencies. Those currencies, once you put into this platform, they'll convert to certain tokens you can exchange, right? So depending what you want, you can convert from one to other, right? So this is all implemented by this automatic market making mechanism, and it's recorded by blockchain technology. So that partially solves this, if exchange try to investigate your trading history, and at least this is one way to avoid this problem. But this is something is coming very popular over the last 5 years, and this technology could be currently is only developing in the cryptocurrency market, and I guess maybe at some stage, once the technology become mature and could be shifted to a stock market later. Thank you.
Any further questions? Or any of your friends online want to ask further questions?
She actually on the.
Yeah, we don't see it here, so sorry, but I'm glad you did.
Okay, new question from me. She's asking how to address liquidity issue in the supply chain.
I'm sure we have expert here, right? Not me, supply chain. I'm not a supply chain person. Yeah, I don't have answer for that, sorry. That's beyond my knowledge. We are talking about something trading the market, right? Do we trade the supply chain in the market? I'm sure there's different ways to address this issue, sorry.
Any further questions? If we don't have any more further questions, let's thank Professor He for today's talk and the discussion. And thank you everyone for coming and joining us today. And thank you, Professor. Yeah, thanks everyone. Have a nice evening, and we look forward to seeing you next month. Thank you.